Hi everyone, my name's Benita. You can call me Benno. I am a certified smart money trader. I've been doing smart money trading for a couple of years now. When it comes to liquidity, ICT and smart money concept have loads of things in common. So that's why I find myself very comfortable on both strategies. I'm going to start analyzing gold from daily time frame, and then I'm going to go decreasing the time frame to the time frames I use for my entries. As we have all seen, gold has been creating all-time high recently, and it's a clear bullish trend on a daily time frame. The only reason why my break of structure is where I marked with a red circle and not higher is because of the inducement validation of the break of structure. So I only trade the break of structures that are previously validated by a inducement. What do I mean by that? Is as we can see here, I have marked the last pullback. I also validate the pullback based on the break on the other side, on the upper side. Then I expect the price after to take out the last inducement, and then it has to create a break with body on the upper side. The moment I see a wick instead of a body, I don't consider that as a valid break of structure to trade on. So I waited here for a better confirmation of the break of structure, and the price went down. It happens sometimes. And then we had a confirmation of break of structure right here. Now, the next inducement, the first inducement was this one right here. This is our current inducement. Inducement is a very tricky element on smart money concept. We can't call this one as an inducement, and there is a reason for that. Like this one here, it's you can see there is a pullback, but that is not a valid inducement since it didn't do a break on the upper side. Our last inducement is right here. Right. Usually, when we have an inducement displacement, I always tend to find two zones. The first zone is the extreme order block, which is on the lowest point of the break of structure. Now, because this is our last valid break of structure, we have the maximum risk point right here. And then we go slowly from the lowest candle, we go slowly up, finding a candle that has left a fair value gap, or how I call it, is imbalance. I'm going to explain also why I didn't mark the first candle here, but I marked the one on behind it. Let me zoom in there. We call these two candles unimportant, whatever you can call it. Because they are within the previous candle behind it. So that's why we always tend to mark the zone from the basic, I call it basic candle, and then find the imbalance on top of it up to the next candle. We can see that the price reacted to this imbalance earlier, but we still need to expect the price to come here, and this right here will be called an extreme order block because it's the lowest point of the last break of structure we have in daily time frame. And then we can see where was the last displacement of our inducement, and that will be our 50% chances to be respected because of the momentum. Usually gold tends to not go on its extreme order blocks, and it just stops on the last fair value gap, takes that out, covers it, and moves to the upper side. So we can expect it also to react from this zone here. Again, the same thing. We can see these candles right here are completely invaluable, or they can't be marked as zones because this one right here is the basic candle. And then we mark that as a demand since it's in the upper trend. We mark this as a demand. And usually I add there a 50%, which means there are chances to go down, but if you want to take a risk, you can, because usually gold tends to, when it's in a momentum, it tends to respect these zones. So in daily time frame, we can expect two options. It can either take this inducement here and go straight up and create a new break of structure, or it can definitely will react here. It might fail to create a new break of structure, and then it might go continue down and take the liquidity pool. So the lowest liquidity pool, which I call low liquidity, is right here. And we can see how much liquidity is resting here and is waiting to be taken all the way up here. This is all the liquidity pool, as we can see. And this, I usually mark it as low liquidity, or the lowest point of liquidity on the sell side. And then we can expect definitely a great reaction here. Right, that's the daily time frame. And then usually I do not check much the 12 hours, 10 hours, 6 hours. I do keep them there just in case. Sometimes I need them, but I always jump to 4 hours time frame and see how it's going in a 4 hours time frame. Here we can see in a 4 hours time frame, we can see that we do have another break of structure which is validated previously by a inducement, and the last valid break of structure is right here. I will explain where is the inducement that has been previously taken off. So this is our last break of structure in 4 hours. Now we do have another inducement, because when we decrease the time frames, we definitely get more data, obviously. So this is the last inducement happened in 4 hours. I'm going to mark it as IDM so we can see the difference in between the inducement on daily. So this, because this is a valid break of structure in 4 hours time frame, it gives more and higher chances for this demand to be respected in a shorter term. So I would keep an eye on this demand on a daily time frame. And also I would mark the demand on 4 hours now, which is right here. Every time we see two time frames correlating with each other in the same place, we know there is quite a strong zone over there. So this is the last inducement in 4 hours time frame. And then the same process continues. We find the last displacement, which was right here, and we can see that the price already reacted there, but failed to create a new break of structure. So this would be our zone on 4 hours time frame, 50% demand. And then this will be a smart money trap, which loads of traders might try and trade it. It's actually an inducement. I usually mark the zones in between as smart money traps, and I tend to stay away from them. And then I would wait for the price to come to this zone over here and see how it reacts. To speed up the process, because I want H to talk as well, I'm going to go to the one hour time frame and then to the 15 minutes time frame. The 1 hour time frame, we can see we can see a change of character. I can see the change of character happened here. Why? Because, as I explained, this is the last inducement. Let me just zoom in so you can clearly see what I'm talking. You can see this one here has been the last inducement, right? Because it's a pullback that has broken the upper side, and then this pullback has been taken first by the price, and then it created a valid break of structure up here, leaving a inducement right here, the last inducement on the back, which was right here. This is the last pullback after the break. Sometimes the last pullback can be before the break happens, which is in this case. And then we expected the price to react here as a POI zone. And it slightly did react, but it failed to create a new break of structure on the upper side. And it came back, giving us a change of character. meaning it will continue on the lower side. Now I'm in under, just because I have marked it already. I think I've shared this with the group already, but I'm going to just go through and explain the details. So I was at this chart on the other broker, at the FX broker. Now we saw some uncertainty on gold because it created here was the next inducement. Here, this was the next inducement. And then the price taken out that inducement and created a new break of structure right here, leaving a zone with imbalance over here. Let me mark it for you so you understand clearly. So this was a supply zone or extreme order block on the sell side. But usually when it's on the sell side, I call it supply. And when it's on the buy side, I call it demand. It makes more sense to me. And then the price did react, but not quite, leaving us with a new change of character here. And then I expected the price to, this was the basic candle here. Since when the basic candle is too big, I usually tend to get the first candle that sweep the basic candle on the upper side. And then I get my stop, in order for my stop loss to be smaller, so I can get better risk to ratio, I mark the last candle that sweep the basic candle, which is right here. And then I did get this trade, which was quite scary because of the news. It went straight down. It was going very well, and it went straight down almost to my stop loss, and then it went up straight away, taking to my take profit. But still, it failed to create a new break of structure, which was quite expected because every time we see change of character happening one after another, we know the price is going to be uncertain, and we don't really know where it's heading. And that's why I explained to everyone there that the next trade, it's going to be very tricky if we took the second trade over here, which started to go quite well, and then as expected, gave us a new change of character on the 1 hour time frame. If the price went lower and created this break here, then this would be our last inducement, and this will be our 50% zone to trade, right? And then if this was the inducement, then we would definitely consider the price reacting right here. But since there is no inducement, no break here to validate this inducement, we can just see the price regulating itself right here, and the inducement remains here. And I usually mark this as a liquidity pool. This is our liquidity pool, which the price must take in order to gain enough momentum and go sell again. Now I'm gonna only explain how I combine the time frames, so it all makes sense, because we know in daily time frame gold is bullish. So someone might ask, why are you looking for sell entries in a bullish trend? Which is a good question, but in smart money concepts, you can combine the time frames, and we can look for sell entries until the price reaches our 50% demand zone on the daily time frame, right? And then we will stop with our sell entries, even if we have a break of structure on the sell side and there is a good supply zone, but we see that it's very close to the demand on daily time frame. We don't take that trade because we know daily time frame is definitely much stronger, will have much stronger reaction than the 1 hour time frame. And then I always, in order to take a trade, I usually wait for a confirmation. So let's presume the price reached in our zone like this. This is now 15 minutes, right? We go, if we want to take a setup on 1 hour time frame, we look for confirmations on 5 or 15 minutes time frame. So if this was the last pullback on a 15 minutes time frame, I usually check if there is a inducement validating the pullback. If there is, then yes, that's great. If there is not, then I consider this not a change of character, but a change in the state of delivery, which is similar to change of character, but it's minor and it's less strong. And then I expect the price to create one more pullback then come to a new zone, which I mark right here on a 15 minutes time frame. And then that's where I take the trade. As soon as the price stops on my zone, I take the trade and I keep it on until the new break of structure happens in 1 hour time frame. That will allow you to have a smaller stop loss, a higher risk to ratio, because the zone on 15 minutes obviously is going to be smaller. And then I take the trade with 15 minutes time frame. If you don't feel very comfortable with a very, very small stop loss on a 15 minutes time frame, you can always keep it safe, play it safe, and put your stop loss the highest point. So this is a failed break of structure, as I marked it before. Now this is the maximum risk in this case. This is our maximum risk. So you can always stay safe and put your stop loss a few pips higher than your maximum risk, and then keep it up until the new break of structure appears on a 1 hour time frame, which will still give you a risk ratio 1 to 4, which is quite good. So yeah, that's what I do. That's the way I trade. I hope I was clear enough. And the next time when I share my setups with the group, I hope you guys are gonna make them useful. Okay, thank you everyone. I will let Henrike take control now.
Thank you very much, Ma.
Thank you very much, Benita, Benno, SMC. We truly appreciate you for today, spending this time here explaining smart money concepts to
absolute pleasure.
Our group and everything. It's absolutely incredible. We appreciate you. Thank you for that. And all my experiences have been trading, ICT concepts. I've rarely seen, like a lot of people that have been on my session, you will know I never invite anybody to any of my sessions. Leo knows that, God's time, you know that as well. I never invite anybody to my sessions. So, but for me to invite Benita, it simply means a lot to me. That is to show you the level of skill that she has in this market. I recognize that, and I wanted you all to see that as well. And hopefully you all have learned something from this session today. So I'm going to be showing you how I trade with the ICT concept. I'm going to wipe my screen so it's a little bit cleaner. My screen is not usually as clean as Benita's screen, so don't expect too much. So the first thing to understand in trading is before I start to look at anything at all, the first thing I want to know is what is the overall market structure? Are we bullish on the 12 months? Are we bearish? Because this gives me an overview to know whether I'm going to be looking for a buy or a sell in the long term. So if on the long term, I'm seeing on the 12-month time frame we're bearish, that gives me an overview to understand that any sell opportunity that I see on the intraday levels is just a retracement and I'm trading against the trend. That is why this is very important, because if I don't understand where the overall market direction is going in the long term, this is when you get into a buy, the market goes for a sell, you go into a sell, the market goes for a buy, and you're left wondering what is going on here. And you're like, okay, maybe trading is not for me. I give up, I quit. You go look for another profession. And I struggle with this myself when I started trading. A lot of the times, more specifically with Euro, US dollar, a lot of the times I'll buy it, go for a sell, I'll sell, it goes for a buy. At some point, I was like, okay, I think I'm gonna call it a wrap and leave this trading thing. It's not for me. Family started to advise me, maybe you should go get a job or something.
We've all been there.
But everything clicked the moment I started my analysis from the 12-month time frame. Everything was easy to understand. It was clear, and I was using this to smash it both in currency pairs, indices, cryptos. This was how I was able to know that Bitcoin was going to rally to an all-time high from 17,000, and I made a video about it, shared it with all our members, and I told them this is going to an all-time high. despite the fact everyone is calling for it to go to zero. I don't care. The 12-month time frame is bullish. Everything is going to follow eventually. And you can see how Bitcoin went straight to an all-time high. Everything we're seeing now is a retracement, potentially to continue higher. But now let's talk about Euro US dollar. And if you're looking at the Euro US dollar, it's very clear as day. Price has consistently been creating higher highs and higher lows, consistently been creating these higher highs and higher lows. This is giving me an indication that us coming down here into this inefficiency here, or a fair value gap, as some people may call it, or an imbalance. I always tell my mentees, the name is irrelevant. All that matters is what it represents. Whether you call it fair value gap, call it inefficiency, call it imbalance, or call it a gap, all you need to understand is, what does this represent? And that is just the gap after an expansion or a displacement, just like this one, fair value gap, fair value gaps. It's just that gap, that inefficient price action. All you need to see is a rebalancing. The algorithm doesn't forget those inefficient price actions, but we traders, we do forget, but the algorithm never forgets. The algorithm could leave an inefficient price action from 1990 and still come back in 2025 to mitigate that inefficiency or fair value gap. Now, as you can see, the first thing we do is to ascertain what is the market structure on the 12-month time frame. And the moment we see this is bullish, that is when we are now scaling to the smaller time frame, monthly, weekly, daily, and we can confidently look for a buy. No matter what is going on around the world, we are confidently looking for a buy. That is how you get into mega trades. So when I say mega trades, this is traded ideas that deliver 1:15, 1:10, 1:20. Those are mega trades. You can actually get into trades that will deliver even way more than 1:20. I think the highest I've been on is 1:25, and hopefully I'm going to break that record soon. But for now, that is the highest I've ever been able to get into. So now the 12-month time frame, we can see that is very bullish. The next thing we do is to scale down into the monthly time frame, and we're looking for opportunities, key levels where price is going to come into for us to look for a continuation to the upside. If we see a counter trend opportunity, a sell on the intraday levels, we just look for low-hanging fruit objectives or low resistance liquidities, and we just scale out of the market because price can reverse at any time to continue bullish. The only trade we can hold for the long term is a buy. I don't know if that's making sense. Is it making sense?
Yes, sir.
Awesome. So now we can see 12 months is bullish. We're scaling down to the monthly time frame. The next thing I do on the monthly is I just use my Fibonacci to derive my premium, discount, equilibrium. The reason I do this is so that when I'm looking for a buy, I want to buy at a discount zone. When I'm looking for a sell, for a counter trend opportunity, I need to be selling from a premium, or potentially best case scenario, I want to be selling from an extreme premium zone for a counter trend opportunity. And I'm looking for exit at the low hanging fruit objective. So the moment to use our Fibonacci from the overall high to the low on the monthly, you can see that we're actually still at premium. You can see that right there. We're still in premium. Right here, this is the equilibrium. So I'm going to write that on my screen. So this right here is the equilibrium zone. Now, we're not looking for a buy above equilibrium. We're looking for a buy below equilibrium. So no matter whatever Euro US dollar is doing right here, all we do is to be patient and wait for price to come below equilibrium into that discount position. Now, all we do is we're looking for key levels to buy and continue higher. Now, if you go to the 6-month time frame, what I'm looking for on the 6-month time frame is my drawn liquidity. What is a drawn liquidity? This is simply a magnet attracting price to whatever direction. So it could be to the upside or to the downside. First thing is understand the market structure. Second thing is understand where we are in the marketplace, whether we're at premium, discount. Third thing is to understand the draw on liquidity. Is the drawn liquidity to the upside or is it to the downside? And as you can see right here, the drawn liquidity, this fair value gap or inefficiency or imbalance, whatever you call it. It's resting right here on the 6-month time frame. So any buy we're getting into, we are targeting for price to keep drawing into that position. Any buy setups, we're looking for a buy to continue higher. Now, another thing I want to share with you is also paying close attention to the low resistance liquidity and the high resistance liquidities. What are low resistance liquidities and high resistance liquidities? These are key levels. For low resistance liquidity, this is a key level that price can easily smash through. And a high resistance liquidity is an area that price will find so difficult to rally or drop below. And right here, a lot of the people, I think Leo and God's Time is still catching up, but Leo understands what I'm talking about right now. Leo, do you understand what I'm saying?
Don't understand.
Awesome. So as you can see, looking at this on the 6-month time frame, this is the low resistance liquidity. So eventually, I'm still anticipating for a run on this low resistance liquidity. And my stop losses, I'll confidently be placing stop losses at high resistance liquidity zone. So this goes into taking trades. If I'm taking a trade, my stop loss needs to be a high resistance liquidity, because that is what will give me the confidence to leave my stop loss below that key level, because price will find it difficult to drop below or rally above a high resistance liquidity. And price will find it so easy to rally above or below a low resistance liquidity. What makes an area a low resistance liquidity is when there is no external run on liquidity. You can see very clearly there wasn't any external run on liquidity right here. There was no external run on liquidity here. That is what makes here a low resistance liquidity. And you can look right here, there was an external run on liquidity right here. Price took liquidity from this previous low, making it a high resistance liquidity. So there isn't really much liquidity here anymore. Sometimes I like to use simple terms to explain things. Just think about it. If you were a businessman or woman, and you know, if you go to the east, you're going to make $1 billion. And if you go to the west, you're going to make 100,000. Which way would you go? Would you go to the east where you make $1 billion, or to the west where you make 100,000? Everyone here knows what the answer is. You're going to want to go where you make more money. So it's the same in trading. The same with the algorithm. The algorithm understands that this key level, the money has been taken. So there's not much money there, but this key level, there's a lot of money piled up here. A lot of stop losses, a lot of trend line liquidities and whatnot. They're all resting above this key level. Now, that being said, the next thing I do after I've derived my drawn liquidity, my low resistance liquidity, my structure, where we are in the marketplace, premium, discount, equilibrium, I'm scaling down to the monthly. Now I'm looking for key levels to buy from. And right here, as you can see, this right here was the last down move before this expansion. And the first thing I do is I just box it for now, and then I focus on other things to scale down into the smaller time frames. And another thing to pay attention, this is resting at a discount zone as well. This is equilibrium. Below equilibrium is discount. I scale to the weekly time frame. And now on the weekly time frame, I'm looking at the structure in the marketplace on the weekly time frame. I'm marking my structural high. This is the structural high here, structural low here. Now, the next thing I do is I want to understand where we are in the marketplace on the intraday levels, because this is the weekly time frame. And I use the Fibonacci from this overall high here on the weekly to the low here. And if I use that Fibonacci, I'll make this red. I'll make it black, or I'll just make it a different color. So I'll make it blue. So now you can see that this key level right here is my equilibrium. So whatever price is doing here, I'm not really interested in it unless I'm trying to sell. But personally, I wouldn't want to sell anymore from here, because we're literally a few pips away equilibrium, and price could dive into this equilibrium, reverse, and continue higher. So I wouldn't try to sell here. The only thing I'm looking for is key levels to buy from. And now I've marked my my weekly high, my weekly low. I start to look at the structure on the weekly time frame. And right here, we have this structural high. We have a structural high here. We have a structural low here as well. We have the structural low here. And then as you can see, we have a break of structure on the weekly time frame as well here, right here, break of structure. The moment we broke that structure, I'm looking for the last down close candle. And right here, we have this is my last down move before breaking this structure. So that becomes my major point of interest where I'm anticipating to see price come into right there. Now I've outlined that key level. First thing I'll do is I'll want to see a 1 hour break. If a 1 hour structure breaks inside here, that is giving me a telltale sign that could be a potential reversal and continuation to the upside. And I'll be anticipating for price to continue to the upside to go into my 6-month draw on liquidity, which I outlined in the beginning. And that is still this key level. Now we still go back into the weekly. Now we're scaling down to daily time frame to dive deeper to understand what price is doing. And now right here, we can see we have this inefficiency or a fair value gap or an imbalance, as you may call it. And the next thing I do is I'm scaling down to 4-hour time frame so I can see the intraday levels. I want to identify where is liquidity, where is the point of interest price could come to, where is the extreme zones. And right here, we have low resistance liquidity resting right here, low resistance liquidity. So this would be an area that price can easily smash through and rally below that key level. Low resistance liquidity resting right here. And here also we have a 4-hour high, 4-hour low, break of structure, significant break of structure right there. You can see that. And another thing I do is I go to the daily time frame. I want to understand what exactly is price doing right here. And on the daily time frame, overall, we have this low. And then, so if we're looking at the swing highs and the swing lows, you can see that on the daily time frame, the major swing highs and the major swing lows, these are the major swing low, swing high right here. And then we'll have this swing low. And then right here, created this swing high right here. And then this swing low. And then overall, we created this high right here. And then this was a run on liquidity. So I can just put it right here as the overall high. And another thing I do is when this gets confusing, when it's this confusing where you're now like, okay, do I call this the swing high or swing low? This is the swing high. This is a run on liquidity. So you can basically use even this high as your overall swing high. Everything that happened here was a run on buy side liquidity to take out anyone who had their stop losses here. I take it to the line chart. If you take it to the line chart, it makes it a lot easier a lot of the times. And looking at it on the line chart, it's way perfectly understandable. Where's the swing high, swing low? You can see that very clearly. This is swing low, swing high, swing low, swing high, swing low, and then the swing high. And you can see this was a lower high right here, and everything here, low resistance liquidity as well. And now you can confidently place your Fibonacci on the intraday level to be this key level. So everything else is for us to derive what I just showed you. Then you can take it back into the line chart and into the bar chart or candlestick chart. Put your fib low right here, put your fib at the highs, and you can basically even delete everything else if you don't want to see anything else on your screen. This is part of the reason why when I look at my chart, I'm like, God, there's too many lines here. But at the end of the day, you have to collect data and you have to do the analysis to derive the key level that is your equilibrium, key level that is your discount. And now you're waiting for price to mitigate the discount zone or the extreme discount zone. And as you can see, this key level is my extreme discount zone. And all I'm waiting now is for price to mitigate this key level. I think I did this analysis with Leo one time. I think it was over a month ago. And I told Leo, if you wanted to buy Euro US dollar, where would be the perfect area for you to buy from? Would you prefer to buy above equilibrium? And Leo literally pointed out this key level. Can you recall, Leo? You pointed out this fair value gap here. And that was like over a month ago. I don't know if you can recall, Leo.
Yes, I remember it.
And price was literally around this key level then. Price was here, and I told him this is the only place I want to buy from. Either this fair value gap or this fair value gap, but I wouldn't want to buy from here because everything here is going to lead to a run on liquidity, continue higher. And look how nicely price came in there, took liquidity, went straight to the downside, targeting this key level. So this right here is the only key level I'll be interested in buying Euro US dollar. If we see price mitigate here, I'll wait for confirmation entries, 5 minutes time frame break or 15 minutes time frame break. The moment I see that, I'm looking for a buy setup. And don't forget, this is below equilibrium, which is discount on the monthly, discount on the weekly, discount on the daily, and also looking at it from the monthly, it's a discount zone on the monthly. And on the 6-month time frame, we're still resting at discount, because if you use the fib from the overall low to the overall high on the 6-month time frame, we're still way below discount, which means there's a plethora of opportunity to get into a lot of buy positions for price to go to the upside. And I would anticipate to see what we call spooling, when price just goes to the upside and not giving you any sort of deep retracement. That is something I would anticipate to happen in the nearest future, because we're resting at deep discount zone on the 6-month time frame. So this is just how I do a breakdown. This is how I derive the market structure, derive my discount premium, derive my point of interest, and the time frame I want to use for entries. Right here, I'll be anticipating to see a potential 5 minutes or 15 minutes break of structure from this key level. Once I see that, I'm looking for a buy opportunity to continue higher. And with this concept, it builds a lot of confidence when you know that the 12-month time frame aligns with your analysis. The 12-month time frame aligns with the daily, aligns with the weekly, monthly. This is when you now build confidence and you look for trades using good risk management parameters. Never over leverage, no matter how much confidence you have in any trade. Always use good risk management parameters. So I hope this has been insightful to every one of you here today. And I've pretty much covered this on Euro US dollar. And I think we've exhausted the time for this live session. It was supposed to be for an hour, and it's past an hour by 3 minutes now. And I appreciate you once again, Benita. I appreciate you, Leo, God's Time, Igor, and who else is on the call?
Eddie only, and then there was a lady as well, but she dropped and she texted on the Telegram group.
Okay, awesome. I appreciate
Thank you, everyone.
Thank you to every single one of you who tuned in today. It's been an amazing session, and hopefully we'll do this more often. And if you ever have any questions at all, feel free to drop it in the chat. And in our next section like this, feel free to drop any questions or anything you're struggling with, and we'll cover it in the next live session we do have like this. I don't know if any of you have any questions so far from the live session.
Well, sir, today was amazing. Thank you for the live section. The one Madam explained earlier is a bit difficult for me, but yours is, you've been showing me this for quite some time now, and I really understand your strategy as well. But I also want to know more on the smart money concept. But I really enjoy yours, and I also enjoy Madam. Thank you for your time, ma. I really appreciate it.
My absolute pleasure. So I will definitely be around on Henrique's Telegram group. I'm there to support, and I will do my best to explain whatever you guys might have, any kind of questions you might have. But I would really appreciate if you make your questions by sharing a screenshot, so I can give you my answers in the best, simplest way possible within your chart. That will make it much easier for you to understand as well. For example, how you find the inducement. If I take your screenshot and mark it within your screenshot, and then you will realize, you will understand more based on what I explained on this live as well. Yeah, I will be more than happy to help. I believe smart money concept is the very in-depth details of where the market is going to go in, and how you can combine all the time frames so you can find as many setups as possible while being very patient and only trading when the price reaches to your setup. It really builds our psychology as well, and it makes us patient, and it makes us feel very comfortable. At the same time, the ICT, I find ICT very interesting, and I am very into learning more about ICT. I definitely get the logic behind everything H explained today, and it feels quite simple to me. And I feel like if we could combine smart money concept mapping with ICT resistance zone for finding the liquidity pool and everything, we can become a very, very, very comfortable, profitable trader, constantly profitable trader. And I'm aiming to get there. I feel very comfortable with smart money, but not yet with ICT. So I'm going to be around the group because I really want to learn more. And I'm going to volunteer with my knowledge, anything that you might need. Thank you so much for joining us today. It was an absolute pleasure for me to explain and be here with you and meet all of you.
All right. Thank you
Thank
very
you,
much.
Henrika, for inviting
Thank
me
you so
as
much.
well.
It's my pleasure. Awesome. Thank you very much,
Likewise.
everyone. And feel free to join the Telegram if you're not there already. And if you have any questions, feel free to let us know in the Telegram. You can message me or Benita directly for any inquiries.
Absolutely.
Benita offers a mentorship program as well. If you're interested, feel free to message her or message in the group. And like you know as well, I do offer a one-on-one mentorship as well. And I'm trying to do this group mentorship for a few people. It's going to be for 1:3 or 1:5 people. But it just depends on the kind of people that want to be in it. They all have to be within the same knowledge base. But yeah, so far for now, it's just one-on-one. And some of you on this call are already on the one-on-one session with me. And how is it going so far for you, God's time? And Leo, how is it going?
Recently, your strategy and what you've shown me in the past week, I would say it's really blown my mind. I'm coping very well. I'm coping.
Awesome. Leo, what about you?
Same here. I understand a lot, not good enough, but I haven't been studying so much lately, so, everything that I've been in, but I understand it all very much better now.
Awesome.
It's very
Awesome
good.
stuff. Yeah. Awesome. All right. We're going to have to wrap it up here. And it was my pleasure speaking with you all today. And I'll see you all next time. Have an amazing day, everyone.
All right, sir.
Likewise.
Thank you very much, sir.
Thank you so much.
All
It
right.
was a pleasure for me as well. Have a lovely day. Bye-bye. Bye,
You too.
everyone.
Bye.
Bye.